Most people think trading and investing are the same thing. They're not. They both involve markets. They both involve buying and selling. They both can make or lose life-changing amounts of money. But they are fundamentally different games. Trading asks, where will price move next? Investing asks, what will this be worth over time? Those are not small differences. Those are completely different mental models. Trading is a battle of psychology and probability in the short term. Investing is a battle of patience and productivity in the long term. If you confuse the two, you get frustrated. You buy high because you're investing, but you sell low because the trader in you got scared. To win, you have to choose your game before you enter the arena. So let's break down the mechanics. The biggest difference between trading and investing is time. Trading operates in short windows, minutes, hours, days, maybe weeks. Investing operates in long windows, years, decades. A trader cares about volatility. They need movement. If the market is flat, a trader is bored. They are looking for the swing, the breakout, or the reversal. An investor, however, cares about growth. They want the underlying asset to become more productive. Think of it like a gardener. A trader is trying to flip the seeds for a profit before they even hit the soil. An investor is planting a forest and waiting for the timber to mature. Time changes the math. Trading resets the clock constantly. Every trade is a new gamble. Investing lets time do the heavy lifting through compounding. Compounding is a structural force. It is growth stacking on top of growth. The longer you stay invested in productive assets, the more powerful the multiplier becomes. Trading tries to outrun time. Investing uses time as fuel. Trading is a performance skill. It requires speed, precision, and brutal risk control. It is more like poker than chess. You are reading short-term momentum. You are managing entries and exits down to the penny. You are dealing with rapid, often painful feedback loops. If you make a mistake, the market punishes you instantly. Investing is a patience skill. It requires conviction, ignoring noise, and understanding fundamentals. You are betting on businesses, on economic growth, and on human productivity. Here is the mechanical trap. The world produces noise every single day. News, tweets, earnings misses, geopolitical drama. To a trader, this noise is an opportunity. To an investor, this noise is a distraction. If you try to invest while listening to trading noise, you will abandon your strategy at the worst possible time. A trader thrives in the chaos of the now. An investor thrives in the clarity of the later. Let's talk risk honestly. Trading has tight, immediate risk control, or at least it should. Traders use stop losses. They cut losers quickly. They manage position size like their life depends on it. Because in trading, one bad day can wipe out a year of work if you aren't disciplined. Investing has fewer decisions, but larger exposure to drawdowns. An investor rides the volatility. When the market drops 20% or 30%, the trader is already out, looking for the bottom. The investor stays in or even buys more. The real difference is how the risk is distributed. Trading risk is concentrated. One wrong move at 10 a.m. can end your day. Investing risk is distributed over decades. The risk in investing isn't that the price drops today. It's that the underlying asset stops being productive over the next 10 years. Neither is risk-free. They just distribute the pressure differently. Now, an uncomfortable truth. Most generational wealth was built through ownership, not trading. Businesses, real estate, and equity. Very few people built old money purely by clicking buy and sell on a 5-minute chart. Trading is a profession. When you trade, you are competing against high-frequency algorithms, institutional desks, and professionals with 10 screens and 0 emotions. You need an edge. If you don't have an edge, you are the liquidity for those who do. Then, there is the tax drag. In many systems, trading profits are taxed as short-term income, the highest rate possible. Every time you close a winning trade, the government takes a slice. This slows down your compounding. An investor, however, can often defer taxes for decades. They keep 100% of their gains working for them, year after year. Trading can generate income. Investing builds wealth. They are different objectives. One pays your bills, the other buys your freedom. Here is where most people lose their shirts. They say they're investing, but they panic when a stock drops 10%. That's not investing. That's undisciplined trading. Or they say they're trading, but they hold a losing position for 6 months, hoping it comes back. That's not trading. That's becoming an accidental investor. Mixing the games is the most common mechanical failure in finance. When you are in the hybrid zone, you get the worst of both worlds. You get the stress of trading without the risk control, and the long-term exposure of investing without the patience. You must choose the game you are playing for every dollar you have. If you trade, follow the rules. If you invest, follow the timeline. Never turn a bad trade into a long-term investment just because you're afraid to take a loss. That is how the salary machine eats your savings. This is the question everyone asks. Which one is better? The honest answer, it depends on your personality, goals, and discipline. Trading may suit you if you enjoy short-term strategy. You can control emotions under high pressure. You treat it like a high-stakes business, not a hobby. You have the analytical stamina to stare at charts and data for hours without losing focus. Investing may suit you if you prefer long-term growth over daily wins. You don't want the daily stress of price fluctuations. You believe in the long-term expansion of the human economy. You have the inaction discipline, the rare ability to do absolutely nothing when everyone else is panicking. But structurally speaking, investing aligns more naturally with how wealth compounds. Trading requires constant, high-level performance. It is an active job. If you stop trading, the income stops. Investing, however, requires endurance. It is a passive structure. Once the engine is built, it runs whether you are awake or asleep. One is a sprint that you must win every single day. The other is a marathon where the goal is simply to stay on the track. In trading, you are the engine. In investing, the asset is the engine. Here's the balanced truth. Many wealthy individuals invest long-term and trade only a small portion of capital, if at all. Ownership is the foundation. Tactical trading, if used, is the supplement. The biggest mistake is trying to trade your way to financial freedom without understanding probability and psychology. Most people enter trading looking for a shortcut, only to realize it is the hardest way to make easy money. They treat the market like a casino, but the market is a cold machine that redistributes wealth from the undisciplined to the patient. And the second biggest mistake is thinking investing means doing nothing and hoping. Both require intention. Investing requires the due diligence to ensure you are owning productive assets, not just speculative bubbles. It requires the backbone to ignore the experts on TV and stick to your blueprint when the world feels like it's ending. The key difference is this: trading tries to extract money from market movement. Investing participates in long-term value creation. One extracts, one compounds. One relies on your ability to beat the crowd. The other relies on your ability to wait with the crowd. When you trade, you are fighting for a piece of the pie. When you invest, you are waiting for the pie to grow larger. Trading and investing are not enemies. They are different tools. But if your goal is long-term wealth, ownership has historically done most of the heavy lifting. The economy isn't a static building. It's a living organism that evolves through productivity. Investing allows you to participate in that evolution. It is the shift that finally decouples your survival from your labor. We've spent centuries defining our value by how hard we work. But as we've seen, wealth in the future is about how much of your life you actually own. As technology and markets move faster, the market value of your short-term trading skills might fluctuate. But the intrinsic value of your time only rises. This transition from being a position manager to being a sovereign owner is where the real freedom lives. Before you choose a strategy, ask yourself, do I want to manage positions? Or do I want to own productive assets over time? Do I want to be the person running the treadmill or the person who owns the gym? Once you answer that honestly, your strategy becomes clearer. Stop fearing the volatility and start studying the blueprint. Don't just watch the price, watch the value. Wealth isn't about how many trades you win. It's about how much time you buy back. If you want to keep breaking down how money and markets really work, simply, clearly, and structurally, subscribe. Let's keep fixing the mechanics together.